right, let's go ahead and get going. We're a minute or so after 9 o'clock. Hey, good morning, everybody. I'm Bill. I'm with Franklin Loan Center. I'm the sales manager in the Temecula office, and we're super excited to bring this presentation for you today. It's we're in absolutely unprecedented times, and one thing that's very different for us this time. When I say us, I mean the real estate industry versus the last downturn, is now we're in this market where our market's going insane. I mean, last time this happened, real estate was at the epicenter of the problem, and now this time we're in a very different world, but it puts us in an interesting position because yes, the market seems really great right now. And Walter's going to go through a bunch of slides that's going to help us understand that. But it's leaving, I think, a lot of customers and a lot of people that I'm talking to are just starving for information, wondering, is this going to last? What's going on? What's happened? Why are we here? And that's what Walter's put together for us today. So as Walter always says, knowledge is power. He's going to leave you with some great information here. What we're going to do, just some housekeeping really quick. There's a in the chat on the side, any questions, just go ahead and type your questions in. We'll come back to those at the end. Alex from our team is going to be monitoring those, and we'll keep those questions, and we'll answer all those at the end. So with that, I just want to introduce Walter. Walter's our CEO with Franklin Loan Center, and hand it over to Walter now.
Thank you very much, Bill, and good morning, everybody. Thank you for all your support of Franklin Loan Center, and specifically the Temecula branch. I know that all of these individuals that make up Franklin Loan Center's Temecula team respects you and is appreciative for all your support. That's obviously Bill Provost, our sales manager. We got Brian Kavanaugh, Dan Evans, Donovan, James Gross, Jose Ramirez, Lori Allen, Maria Martinez, Sal Nunez, Sam Hagan, and it's a great cast and crew, and they are setting some unbelievable records and doing some tremendous business, and none of that can be done without your support. So this is one of the ways we love to get back. As Bill says, knowledge is power. So these presentations, seminars, we put a lot of thought into them. We want them to be thought-provoking. We want them to be a value add to you. And we want you to leave this seminar going, I learned a couple things, and I'm thankful for that knowledge to be able to pass on, not only to my clients, but to my family and friends as well. And so life comes full circle when it comes to all those aspects. So thank you for the Temecula team for all you do for Franklin Loan Center. We are honored to have you guys part of our company, and we're thankful that your referral partners support you to the level they do, because without you, we don't have anyone to talk to this morning and add value back. So thank you all of you for being part of Franklin. I'd like to go through the topics of what I'm going to be talking with you today. The nice thing about this presentation, it's fast. It'll be about 45 minutes. I'm going to go from topic to topic. So if you're bored, wait about 3 minutes. I'll be changing topics. Hopefully you'll love all the information and it'll be helpful. So this is what we're going to be reviewing today. The CIA test, that's credit, income, and assets, and what that exactly means in this market. We're going to give you a forbearance update. There's still lots of questions about forbearance. I'm going to break it down very simply for you. We're going to talk about some of the updates Fannie Mae, Freddie Mac, and FHA have had as well, and how that might impact you as agents or your buyers or sellers. We're going to talk about appraisal updates and what we're seeing in the appraisal world, how that might educate you and give you maybe a leg up on the competition of how to work through those appraisal issues. We're going to talk about a bid-ask worksheet, and this is something you're not going to see many other spots. It's really a great mindset adjuster for your buyers and sometimes even your sellers. So we'll get into that. I'm going to talk to you about how interest rates truly work with risk-based pricing, and why you might have a client in Temecula that gets one rate, another client gets another rate. So I'm going to give you a quick education on that so you can be a leader for your clients and explain to them why things are happening. We're going to talk about record low interest rates. We all know it's there, but I'm going to talk more specifically about an opportunity where you might see 20 years down the road because of this, and that's a retirement boost. So I'll get into that. I'm going to talk about affordability factors, the things that really drive the ability for your clients to buy a home. If people can't afford homes, they can't buy. So that'll be interesting as well for you to sort of analyze that. We're going to talk about the 2-10 Treasury spread update. I never do a seminar presentation without talking about this slide, because I think it's the #1 predictor of recessions. And so I'll talk about what we may be seeing recessionary coming or not. And then I'm going to close with about a 7 to 8 minute presentation on the national housing outlook. You might say, Walter, why would we be concerned about a national housing outlook when we're really concerned about the Temecula area? And I think sometimes it's nice to know what the difference is maybe nationally compared to what you're seeing in your market, because then that gives you perspective. If you're in a better position, it gives you perspective to pass on that sort of opportunity and mindset. Hey, we should be really fortunate that we are in the Temecula market because of what this market looked like compared to the national housing outlook. But it's going to be interesting to see what you guys draw. If you see there's some comparisons between Temecula and the national housing outlook, I personally think there is. So I'd be excited to share the national housing outlook with you as well. So let's dive right in. Please, if you have questions, I'd love to answer them. Please type them in. Once again, we will answer them. These slides will all be available to you that you can request from your Temecula loan representation, and then we'll forward it to you. And if you have further questions from there about the slides, they can answer the questions. If you're wanting specifically something from me, you didn't get a chance to ask today, they can forward your message on to me as well. And I'd be more than happy to answer it to the best of my ability. Ultimately here, I'm going to be presenting a lot of facts, but I'm also going to be presenting a lot of my personal opinion as well. And so you guys need to look at the facts and see if you agree with my perspective or not. And that's okay if you don't, but at least you've got the facts and you can form an opinion from them. So let's go back to basics. When you're in uncertain times, and this is definitely uncertain times, COVID-19, when we don't really know what tomorrow is going to look like, especially when it comes to employment and the stock market and income and even assets, how much money people have in the banks start to get concerned. Because imagine you're lending your money and you're lending money to someone who might not have a job in a month, or maybe has a job but isn't fully employed, making half the income. You'd be concerned about lending your money. So the banks are going back to basics. And what are basics? I like to call it the CIA test. And if you can pass that, you can get a loan. Now that sounds scary, but CIA stands for credit, income, and assets. Basically, if it's a conventional loan, we're looking for a FICO score over 620. Okay. And if it's an FHA loan, we're looking for a score over 580. So that's the credit piece. That's the basic black and white. Then we're looking at income, documentable income on tax returns, and making sure that it's consistent and that people are back to work. And we're looking at debt to income ratios specifically when it comes to qualifying someone. So conventional loan, maybe up to 50%. FHA loans, maybe as high as 57. So there's some flexibility on the income, but we're black and white, income numbers, DTI numbers. And then last is assets. We're looking to see if people have seasoned money, cash deposits, or large deposits in the bank to be able to use that money for a transaction. So banks are highly scrutinizing CIA. What does the credit look like? What does the income look like? What do the assets look like? That's as basic as it breaks down to. That's really what we're doing every day right now, is super analyzing those three pieces. So back to basics, that's what lenders are doing. I want to give you two things though that I really encourage you to pass on to your future buyers or sellers, because anyone who's going to be buying or selling a home and needs to get financing, they need to be prepared to do their part. And if there's anything today that you as a real estate agent can pass on to your buyers and sellers ahead of time, is tell them to sign up for online banking. It is almost impossible to get a loan today and get it done efficiently and quickly without the borrower having online banking and be able to access their bank statements quickly, so that they can get them to a borrower, not only to document maybe deposits, document IRA distributions, earnest money deposit, but these types of things have to be updated monthly now because of COVID. And so without online banking, waiting for statements to come in the mail, waiting for something to come in the mail regarding a deposit in the middle of a month, that's going to delay an escrow and almost make it impossible to close on time. So please talk to your buyers and sellers ahead of time and say, if you're not signed up for online banking, please sign up. The second thing is I'd like you to tell all of your clients is electronic financial documents. They should have their W-2s, their pay stubs, their tax returns, their driver's license. They should have things like that that are automatically in their computer system as a PDF saved electronically. So if we're asking for them, they don't have to go to their CPA, they don't have to go to their employer, they don't have to figure out how to get a picture on their phone and send it. Have them be prepared for a 30-day escrow, because today all the sellers want top price. Obviously, if you're a seller, you want it, and all the sellers want to close quickly. And if buyers aren't prepared to do their job with online banking, electronic financial documents, it's really difficult for us to deliver. And the pressure of that building up when they're not doing their portion is extreme. So if there's two things that anyone ever asks you to be prepared for a loan, those should be the two things you're advising your clients today. So let's jump into forbearance and update you. I use the word penalty box for forbearance because if you use forbearance, you're going to go in a penalty box, which means you are going to be in a financing freeze, which means you will not be able to borrow money. Now, that doesn't mean you can't borrow money quickly if you go through the right steps. So I'm going to talk about the 4 most likely outcomes you're going to have if your client goes through forbearance. Okay, the most likely outcome to be able to get financing right away and get out of the penalty box is a lump sum payment. So real quick, let's visit forbearance. What is forbearance? You hit a pause button on your payments. You tell your lender, I'm hitting pause. I'm not making my payments. And let's say a borrower has done that. And now they're 90 days into the pause. And now they're feeling more comfortable. They're back to work. They're not as concerned about the future. And they want to start making their payments again. Well, there's 4 options for them when they come out of pause to hit play. So imagine you hit pause on a movie. You're in forbearance. You hit play. You're out of forbearance. Now you're watching the movie again. Now you're back in life, right? The number 1 option and the best way for your borrowers to be able to get a loan and buy a home from you or sell a home and buy another home is a lump sum payment. I call that reinstatement. So basically what that means is if they're 90 days behind, they got to write a check to their lender for 90 days, pay all of their arrears that were they were in the pause, and then we just get a credit sub from their lender and servicer that they're up to date and they can borrow immediately. So someone can do that whole process in 3 days, which means they're now out of the penalty box and they can borrow money to buy a home and work with you. That is going to be the best way to get someone out of the penalty box quickly to be able to borrow money at these low interest rates, historically lows. Okay. The next option is a payment plan. A payment plan is similar to the reinstatement, except you pay it over time. So let's say you had 90 days or 3 months of payments you missed, and you tell your servicer, I want to pay back those 3 months over the next 6 months while making my whole payment moving forward. If they pick the payment plan option, they're going to be in the penalty box for the whole payment plan option. So that's 6 months. Plus, they're going to have to be out of the payment plan for 3 months to be able to buy. So they're going to have to wait 9 months to refinance or buy. So the payment plan option is not ideal for your borrowers to be able to buy or refinance now. So I would probably refer them away from that option unless they don't need to buy anything or finance anything in the next year. The next option, which is going to be the most common option, because it's the option that allows the borrower, for lack of better terms, to kick the can down the road, is the deferral option. And that means if you're 3 months behind and you come out of pause, you can add those 3 months to the end of the mortgage, which means they don't have to make a lump sum payment. But if they do the deferral option, once they defer those 3 payments to the end of the mortgage, they need to wait 3 months and have 3 consecutive payments where they made their full payment when they've come out of pause, when they've gone back to actively making their payments. So I'll give you an example. If somebody in the month of August made their first payment out of deferral, they'd have to wait August, September, October. They'd be able to buy November. So the deferral option, it will be the most common, but it's not the ideal option for someone to buy a home in 2020. They could do it early 2021, but it's going to lock them down in the penalty box. So you want to tell people to not go that option unless they can wait 90 days. And the last option is a loan modification. This is really the last resort. And this is something people should only do is if they're going to lose their home to short sale or foreclosure. The loan modification option was the only option people had in our last recession. And that's why so many people lost their homes to short sale and foreclosures, because they had to go wait before they get a loan modification. The beautiful part about this time around is our financial industries have learned a lesson. And they learned that we need a better option than just having loan modifications. And if we just had loan modifications through COVID, you would have seen a huge spike in foreclosures and short sales. And that's why you've seen inventory stay low and that not happen, because they came out with the CARES Act in March, which allowed people to go into forbearance up to a year to keep their homes. And so this was a very positive reaction and sign that our government and Congress did to help really support the American people through this time. So I was really excited about seeing them actually put an option out that was viable. I wish they would have made the forbearance option something you had to qualify for, because 80% of people who used it had, $1 million in the bank, $500,000, could make their payments. but they just thought it was, oh, we should just do it because it's there. I wish they would have made it qualify for those people that really needed it. So those are your 4 options, and that should help you counsel your buyers and sellers. If you need more information on it, please reach out to your Franklin Loan Center rep. I know it's somewhat of a complicated subject that I went through fast, but we know it inside and out and can support your contacts with updated information on this. Let's talk about some of the changes Fannie Mae and Freddie Mac and FHA have had that might affect your buyers and sellers and things maybe you might not even know as an agent, that I think it's important when you're out there advising your clients, and that's first of all, the self-employed rule change. So a lot of you agents that are on the call are on the seminar here are sole proprietors where you follow Schedule C. So you're self-employed. This would apply to you. If you're self-employed and you're trying to apply for a loan, the banks will look at what you did in 2018 and 2019. They want to make sure that looks solid. Okay. And if that's solid, the second thing they do, and which is the most important thing, is they look at what you've done lately, what you've done in 2020. Sort of the Johnny come lately. They're concerned about what you are doing in the last, really the full 2020 year, but also the last 60 days. So we're required through Fannie Mae and Freddie Mac change to get bank statements for the last 60 days for any self-employed borrower to document that the deposits going into the bank will support the income and that they were making previously before COVID. If it looks like the deposits are down 50% and the profit and loss is down, we're going to have to use their 2020 lower number to qualify them. So a lot of agents still out there, I don't know about this rule with all self-employed borrowers, but that's something we have to do. So it's important for you to know when you're talking to buyers and sellers that are self-employed that they really do their homework with a lender to make sure that their current last 60 days is going to support their income to qualify. Another thing that changed because of COVID is the assets. Assets used to be good for 120 days in a loan. So we get assets when we qualify a borrower, and for 2 months, that'd be good for 120 days. Well, now we have to continue to update the assets, only good for 60 days. And so that's another, once again, back to one of my opening points is if someone doesn't have online banking continually to get us updated assets, it's going to be a challenge for us to really service you and give you the service you need and a borrower to close on time without getting those updated asset statements. We're waiting to be snail mail, or the borrower has to go to the bank and get them printed. So that's another thing that's causing some delays. But this third thing here is probably the biggest delay and the biggest change we've had in closing loans on time with COVID, and it's the verification of employment changes. We used to only have to verify employment at time of approval when going to loan docs. We'll redraw the documents, send them to escrow, client signs them, docs back, we close. We have to verify the employment at time of moving to file the docs, and we have to re-verify the employment at time of funding. And you know how funding goes. You're trying to get before cutoff. We've got our funding department trying to get a hold of people to confirm they're still working. And believe it or not, we've had a lot of cases where people were working and then 10 days later they weren't working in this COVID environment. So you have to please be patient with funders and lenders trying to re-verify employment, because maybe the one person who verifies the employment is out sick that day, or isn't answering their emails or answering the phone calls. So sometimes there's only one person to go to. Sometimes there's more. So that's been a major change. So we do our best up front to get the contact of the correct person to call at funding day. So there is not a delay, but sometimes that happens. Another issue with COVID is furlough income issues. We get a lot of questions on this, especially from agents and borrowers. Can you use what the borrower used to make before COVID? They're only working 30 hours a week. They've worked 40 hours a week every week for 10 years in this company. But now they're only 30 hours a week and they're going to go back to 40 at some time. No, we have to use what their current employed hours are. We can't take an average. We've got to be, unfortunately, conservative based on Fannie Freddie's rules and Jumbo's rules as well, that we are using their current workload. So that's something else you need to know. Another thing is the FHA 6 months reserves. This is sort of a thing that bites up and can bite us if we're not aware of it. And that is someone who has an FHA loan. They want to move to a different area because of COVID, which is very common right now. People moving out of big cities and moving into the suburbs and the exurbs I'll talk about later as well. And if they move into another market and want to get another loan with FHA, they've got to have 6 months reserves on the home they're leaving before they count rental income on that home, which is something they added because of this as well. So that's a new twist. In this last thing here, I added this. I've given this seminar now 2 or 3 times in the last month, and this one I've added for the last 2. And it's the refi adverse market fee. A lot of you might have heard about what happened with FHFA, which is the managing arm of Fannie Mae and Freddie Mac. They came out and they said that we're going to charge 0.5 point in fee on all refinances moving forward. That since has been delayed till December 1. But what this what this means is any loan that Fannie Mae and Freddie Mac buys and puts into a security by December 1 is going to have this 0.5 point fee. And so the good news is we were able to get this fee pushed back. FHFA pushed it back for the whole country, which was a great relief. But that 0.5 point fee is now in the rate sheets for all banks, because by the time a refinance closes and actually gets securitized in Fannie and Freddie, the 0.5 point fee is going to be there. So for those people that delayed the refinance, they might be getting a slightly higher rate today, but ultimately, as long as the Fed continues to purchase mortgage-backed securities and bonds, I think they're going to push the rates back down, and probably will be very similar where they were. So that was something that sort of rocked the market. You might have heard about it. The good news is right now, I think the market has absorbed it fairly well, and things are looking up with rates, even on refinances. And I'll get into how we price the difference in rates here later as well. Appraisal update. This is a hot topic. I want to talk about three things here. First of all, is property inspection waivers. A lot of agents, and still this day, I spoke to one yesterday, didn't know about this. A lot of agents don't know that we are getting a lot of property inspection waivers. And what that means is we don't need an appraisal. And what do you mean you don't need an appraisal? Well, when we run the loan through Fannie Mae and Freddie Mac, if Fannie Mae and Freddie Mac had been a previous lender on the property and they feel comfortable with the value that we're putting in the system, it was to give us a property inspection waiver, which means the property doesn't need to be inspected. It doesn't, we don't have any issues with value because it can't come in low if we don't have the appraisal. We don't have any issues with if the property is needing any improvements done to it or upgrades. So that's a really positive thing that the Fannie Mae and Freddie Mac have been passing on. So many of you who are on the listing side, you might not have someone coming out and actually doing an inspection. If that's happening, please reach out to the lender and say, hey, why haven't you done an appraisal? They might tell you they got a property inspection waiver, which is pretty cool. My only red flag about that is 95% of the time that works. We've had a couple cases where the property inspection waiver was lost during the transactions. We got to continue to run that loan through Fannie and Freddie. And it's unfortunate, but 95% of the time it's a blessing and works. So there is a little bit of a red flag sometimes on those POWs. Appraisal value concerns. Over the last 90 days, we've seen the appraisals coming in low, about double to what we did in the previous 90 days. I think everyone knows real estate values have been going up. When real estate values goes up, it's much harder for the appraisers to keep up with that appreciation. So we are seeing a lot more value concerns on the appraisal. I'm going to talk about a tool that you can use to change the mindset of buyers to buy homes even when the appraisal comes in low. So this tool is great, and anyone at Franklin Loan Center can get this for you. It's the bid ask. So I'll get to that later. So that's what we're seeing with appraisals and the values. And the last thing is the drive-by appraisal options. There's also the ability for lenders to get an appraisal done on a drive-by, which means the pictures of the house is taken from the outside. No one goes inside, which can be a relief for a lot of people in this COVID environment, that they're not letting someone into their home. It also helps if people have the inside of their home, maybe they're doing a remodel, which typically would halt the loan from closing. We wouldn't know about the remodel. So there is some advantages to the drive-by appraisal option for COVID, as well as the condition of the house. So that's what I'm seeing on the appraisal updates. Okay, bid ask worksheet. This is something that I don't know how many other lenders are offering this service to you, but your Franklin Loan Center rep can. And this is a mindset change. This is you. So all we need to do this for you guys is MLS listing number. Send us MLS listing number. We'll create this bid ask worksheet for you. And this is to show a buyer, if they buy a home for more than it's appraised at, how long it'll take them based on forecasted appreciations for the market you're in to get their money back. Because ultimately, some people can't get past paying 15 grand over an appraised value. So in this situation, we have an asking price of $539,000, and the buyer's going to pay $554,000, which is $15,000 more. Okay. If you look down here below, you'll see that it takes them until November of 2020 to get back the $15,000 they overpaid. Okay. So that only takes them 3 months to get back the overpayment. And now they got the home they really wanted, and they're in the home. And look at the 5-year forecast appreciation. It says 5 years from now, they make $171,000 on this home. So should they really be that concerned about the $15,000 if they're trying to find a home to live in with their family, and this is the home they really want for the school zone, maybe it's the neighborhood? They should get comfortable with the fact that they might need to pay a little bit more, especially if it's one of the nicer homes, because how comps work on appraisals. If you're buying one of the nicest homes, if it's the nicest home, you're not going to have a comp to support that. So sometimes you're going to have to pay more. But this bid ask worksheet, I've used this, and I've had 6 buyers who were going to cancel. I've gone over this with them. and they decide, you know what, you're right, Walter. I was looking at this in the wrong perspective. I should buy this. This is the perfect house for my family. $15,000 in the overall picture, especially with forecast appreciation, is nothing. It's a blip on the radar, and that is correct. So this is a great slide to change the mentality for your buyer and seller. Excuse me, guys. I'm going to turn the air down for me here. Hold on. Sorry about that. It's a little hot in here. Okay, so let's get into risk-based pricing and how that works. This is something also, if you take one thing from today's presentation, I want you to remember this concept, because loan officers, we are paid fixed compensation. So if we give someone a rate of 4% and another person a rate of 3%, we don't make any more money. So there's no motivation for a loan officer to give a higher rate to a client. But the rate the client gets is based on the client's personal situation. And so let me tell you the factors that affect the interest rate. It's all risk reward. Remember I mentioned earlier about you lending your money. Imagine you took your money out of your pocket and you lent it. And you were lending to someone with a good FICO and a good job with a lot of money down. That's a less risky loan than someone who's putting down 3.5% with no money left in the bank and a gift to close and a bad credit score. That's a borrower that might have a better chance of defaulting. So it's all risk reward. So what are we looking at on the risk reward? Well, we're looking at the occupancy. A primary residence has the best rates. Second home has the second best rates. Investment properties are non-owner occupied, NOO, have the highest rates. So we look at that. Second thing we look at, obviously, is FICO score. The higher the FICO score is, the better judge of that person is going to make their mortgage payment or their car loan or their credit card payment. So the past is a good value of the future, or a good prediction of the future. If someone doesn't pay their bills in the past, there's a better chance they might not pay in the future. If someone's always paid their bill in the past, there's a good chance they'll always pay moving forward. But there is no perfect credit score, because you never know what someone's going to do tomorrow. So FICO score will greatly impact the interest rate. The third thing is down payment. How much money is someone putting down? The more money someone puts down, the better interest rate they can get. The less money they put down, the higher interest rate they will get. So down payment, how much money is in the loan, will affect the interest rate. The next thing is property type. And a lot of agents, I don't know, they know this yet, because I talk about a lot, some people don't know about, is single family residences have the best rates. PUDs are basically the same thing. They have the same exact rates as a single family residence. But condos have higher rates than single family residences and PUDs, because the default rate on condos is almost triple than single families. And that's historically speaking. And that's because a lot of people buy condos, they're buying a lower priced home. They're not committed to it. It's an investment. It's a second home they might be using a couple weeks a year. When that investment goes under, they're quickly saying, I don't care about that, just take it. So the condo market is a little bit more flaky than the other markets. So the risk on the condo market, default rate risk, is much higher. So that has an impact. And then the type of loan has an impact. I talked about the 0.5 point of fee that has been added to all Fannie Mae and Freddie Mac refinances. So purchases have the best rates. A rate and term refi, which means you're pulling no money out, has the second best rates. And then a cash out refinance has the highest rates. So you can send someone in to see Bill at Franklin Loan Center, and he meets that bar at 9 a.m. and he gives that bar 2.625% on a 30-year fix. You can send a client to Bill an hour and a half later and sits down with Bill and walks out of his office with a rate of 3 3/4, a point higher. That is because one of these risk-based pricing scenarios, or a couple combined, low FICO, low down, condo, non-owner, you put them all together and it comes out with a rate. So this is what is affecting interest rates. And this is why people have such huge differences between what they're getting because of these scenarios. So I hope that clears up rates. Okay, this is a cool slide that I put together. I think this adds a lot of value, and it adds a great mindset of what's really the opportunity we all have today. Record low interest rates is equaling a retirement boost. So let me give you an example. This slide shows someone who's at the age of 45 years old who wants to refi at the age of 65 years old. So he wants to work for 20 more years. He wants to have desired $50,000 of income at retirement, which is 65. He currently only has $185,000 saved for retirement. and I'm making some assumptions here. Yeah, making an assumption of 8% return while he's working and 5% return after he retires. We need to get this borrower or this friend or this family member to $1 million in the bank by the time they retire to be able to get $50,000 a month of income. Well, what does that friend or borrower need to do to get 20 years down the road to get the $1 million? They've got to save $231 a month. That green number you're looking at, that gets them to where they want to be in retirement. Why am I bringing this slide up? Well, two reasons. One is with ultra low interest rates, historically low, if someone's saving 1% on the average loan amount out there, $300,000, they're saving $300 a month in mortgage payment. If people just refinance today, and instead of taking that money and spending it on lifestyle or spending on things they really don't need, they just put that money towards retirement, they're going to set themselves up to be retiring in 20 years because of just the savings for the opportunity that we all have today with these low interest rates in this COVID environment. So I think this is a great opportunity, and I think you're going to see a lot of people retiring younger 20 years from now because of this. And maybe 20 years from now, you guys be like, you know what? Everyone's retiring around me at mid-60s. This is why they're going to be retiring. So maybe take advantage of this opportunity. Refinance your homes. If you want to buy a home, go out and buy them right now with low interest rates. Talk to your friends, talk to your future clients about this topic, because this is real life stuff that makes a difference and no one's talking about it. So I hope that's helpful. Affordability factors. When it comes to buying real estate, in the good times, people buy it's because they can afford, right? No one buys a home, they can't afford it. So the affordability factors have to be good in an environment to have a strong real estate market. Well, I'm going to talk about the three things that make up the affordability index. It's income, it's interest rate, and it's money, down payment, assets, how much money they have in the bank. And I'm going to give you my opinion on them and why I think we have great affordability. The first is income. Income is the largest factor in affordability. If people are making a lot of money, they feel good about going to buy because they feel like if money coming in, they don't mind money goes out. So the more money people are making, the more confident they are to buy. I'm going to make an argument that income is sideways right now, okay? That there's 50% of people today making more money than March when COVID started, and there's 50% of people making less than March when COVID started. I personally think more people are making more money since COVID. I think it's more like 60-40. So being conservative, I'm going to say it's 50-50. So the affordability factor of income is not up or down, it's flat, okay? Even though I think it's up. Second is interest rates. Well, we all know we're at all-time lows, historic lows. So with interest rates being low with the green arrow, income, which is the second biggest factor for affordability, is up. The affordability factor for income is up, so that's great. So the second thing is positive. The third thing, smallest factor, is down payment. How much money they can put down, okay? Also, how much money they have in the stock market, how much money they have saved. I personally think most people left their money in the stock market. Stock market is completely recovered. I think people have more money today in the stock market, in the bank, than they did in March, more than 50%. But I'm going to be conservative once again, just say it's 50-50. Let's say 50% of more, 50% of less, even though I think more than 50% have more. So let's say that's sideways. So you got two sideways and one up. So this is basically telling you affordability is up. In my opinion, all three factors are up, which means affordability is solid, and you're going to see a great market moving forward because people can afford to buy homes. So affordability looks good. Okay, home mortgage product update. Jumbo loans. In Riverside County, the jumbo loan limit is anything over $510,400. There are a lot of rumors out there that people cannot get jumbo loans. Well, that's false. There are a lot of the big retail banks, Wells Fargo, BofA, Chase, you know them all, that are making it very difficult for people to get jumbo loans. There are a lot of mortgage bankers out there, not Franklin, but there are other mortgage bankers that don't have good options for jumbo financing. We at Franklin can do jumbo loans. We've got 4 or 5 great outlets for them at great rates. But the one thing you do need to know about jumbo loans is I talked about CIA, credit, income, and assets, how banks are they're super laser focused on those 3 things. On the jumbo market, they're even more focused, especially on assets. So someone's trying to get a jumbo loan and they don't have 12 months reserves of the payment, maybe sometimes 24, 36, they're not going to get a jumbo loan. So jumbo borrowers must be well qualified, and they can definitely get rates. We're locking jumbo loans at 3.25% on a 30-year fix. So the rates are great, and we can do that. Non-QM bank statement. In March and April, these things dried up. They're back. Franklin Loan Center has its own proprietary product with great rates, in-house underwriting. We can do them. So if you have those clients, give us an opportunity to talk to your borrower, maybe infuse some hope and optimism for them that's there and can be done, and we'll advise them on what they need to do to get done. So those files are back, and we're doing it. Bridge loan financing. Franklin Loan Center has its own bridge loan financing product. It's our own money, and we underwrite ourselves. Now, the bridge loan, fortunately, isn't needed as much today, because what's happening when someone puts a home on the market, it's selling very, very quickly. So we're not having to do nearly as many, because people are selling their homes fast so they can move up or they can move to a different market. So the bridge loan financing product is still there. We've never left it, never went away, and it's there to help you. If you need it, talk to a Franklin Loan Center rep. And the fourth thing here, home mortgage update, we're still doing to be determined underwriting. You get someone pre-approved so they can put in maybe a 15-day escrow. It's more challenging in this environment because I got to tell you, every escrow title company is slow. Every appraiser is slow. Every inspector is slow. Agents are slow just to get their paperwork done. Lenders are backed up. So the to be determined underwriting is there. We're going to have to be patient for us to be able to get that done for you, but it is an option. So there's some just some basic home mortgage product updates. Once again, I talked about this on the opening. This is my favorite slide. I don't do a presentation without talking about it. I don't love talking about recessions, but I think it's important for us all to know what is coming so that we can prepare our own lives for it, as well as our friends and our clients. And this shows you going back to 1976. It only goes back to 76 because there wasn't a 2-year and 10-year Treasury bond back 1975 and later. There wasn't a 2 and 10 to actually compare. So it started in 1976 when a 2-year Treasury option came out. So this shows you the recessions we've had since 1976. It's the gray bars on the chart. You'll see there's 1, 2, 3, 4, 5 of them. Okay, those are all recessionary times. And you'll notice every time we went through a recession, this chart went red before we went into a recession. So you see the first recession, red recession. Second recession, red recession. Third, red recession. Fourth, red recession. So this shows you whenever you find that the 10-year money becomes less expensive than 2-year money, then we go negative on the chart. So if you're putting money in a CD for 10 years, and they're going to give you 2% to lock your money in for 10 years, and then you go into a bank the same day and you lock your money in for 2 years, and they give you 3%, they're going to give you more money to lock your money in for 2 years than 10 years. That makes no sense. You should get more money the longer you lock up your money. Same thing in the mortgage industry. The shorter the fixed rate, the lower the rate should be. The longer the fixed rate, the higher the rate should be. So whenever you find a market where you have a switch between the cost of 2-year money and 10-year money, that's because the future is uncertain. And people are so worried, banks, about getting money that they're willing to pay you more for short-term money to get it now than they are for long-term money. And so that's when it goes red, is when short-term money is more expensive than long-term money. And that's always a key driver of recession. So if you look at the end of the chart, you'll see in 2019, we went red for like 3 days. It was exactly 3 days, and we've since pulled out of it. Because that didn't last for more than like a month or two, I personally think by this chart that we're not in a recession yet, and a recession isn't likely to come for at least another 6 months because we've got to get down and get red again. So right now, the future looks good for not having the big R based on this chart and based on history. Hope that helps. All right, this is a national housing outlook now I want to give you to look at. And as I go through this national housing outlook, I want you to think about, is this similar to what you have going in Temecula? I think it is, but let's talk about it. The number one thing I want you to think about here is marriage, because marriage drives real estate. Now, why do I say that? I say marriage drives real estate because children drive real estate. And the thing we need to look at is, when are people getting married and how frequently are people having children? That'll give us a good idea about the health of the real estate market moving forward. Well, you can see that men and women are waiting longer to get married. Men are waiting about 28 years old to get married, and women are waiting to be about 26. So people are waiting longer to get married, and that's important to understand because of the children aspect. So people between the age of 30 and 39 years old are 38% likely to buy a home with no children. If you have one child and you're married, you're 80% likely to buy a home. So that is the driving force, the white picket fences, the yard, the dog. People want to have that when they get married. And if people have two children, it goes from 80% to 83%. So it's very important to understand what drives your industry, and that is marriage and children. So let's look at what we have coming. If marriage and children drive real estate, Walter, then why would baby registries be a good thing? Well, look at what's been going on. This chart goes back to January 1st, 2004, and you can see it was below 25. You can see where we are now. It's topped out at 100 and stayed there. And this is telling you that there's been a dramatic increase in baby registries on Google, online, with Pottery Barn, with all those types of things. And this has only been tracked since 2004, so we can only go back 16 years. But right now, people are either having children or expecting children, which means we are going to have a housing boom over the next 4 or 5 years because all of these people are going to want to have a home to put their family in. So we are in a good industry for the future. And this right here is the driving force of why it's going to happen. And even if we go through recessionary times, and even if interest rates go up, that could slow things. But there's always going to be the need to own homes because of this. So this is very promising of the next baby boomer push. So let's talk about what people are looking for. What are these families looking for that are buying homes right now? They're looking for more space and distance. So look at this chart here. The blue dot is urban markets. The green dot is exurbs. And that's right, it's exurbs, not suburbs, okay? So I'll get into that in a minute. So let me explain what this chart means. The urban market since 2015 has been declining every single year, but no one was really talking about this trend until COVID hit. COVID just magnified this. This was already happening. People were leaving the cities and they were going to the suburbs. They wanted out of that because of the children. They wanted to get in markets where they could raise a family, better school zones, not huge public transportation. So that's been happening. But look at the exurbs. Look what's been happening since 2015. People have been moving dramatically to the exurbs. The exurbs are, so you got the urban markets, then you got the suburbs right out of the urban markets, okay? And then you got the exurbs, which go even past the suburbs. And the exurbs are even more popular now than the suburbs. So the suburbs and exurbs, which are outside the urban markets, they will continue to be the place people are looking to move with their families to get out of the hectic hustle and bustle of what's going on in the big cities. And it's just not because of COVID. You can see this trend's been in place. It's just being magnified. And it's interesting how media and people are always years behind the curve. Because I got to tell you, I didn't know until I did the research that this was a trend that was going back 2015. I thought COVID started the trend. No, COVID didn't start the trend. The trend was happening. COVID magnified it. So interesting perspective. Young adults driving growth of homeownership. I talked about that. But I want to talk about the three biggest age groups that are driving growth. It's under 25, 25 to 29 is the second biggest, and 30 to 34 is the third biggest. And those are all ages of people getting married and having children. So once again, the facts are obvious and they show you where you should be spending your money marketing, and it's in young people. And I'll tell you, if you spend your money marketing young people, not only will you get that first transaction, but you'll get many, many more. How often do they move within 12 years? People under the age of 35 move 4 times on average. 4 times. People having more children, they upgrade their homes for more rooms. Okay, they have 2 or 3 children, they realize they're in a school zone they don't want, they move to the school zone they want. Okay? So they move much more frequently. Look how many times they move over the age of 50. 1 time. So if you want to spend your money smartly marketing for not only the current, but the future, look for youth and look for babies. Maybe sit outside the hospital, say, do you have a baby? Here's my card. I'm joking, but honestly, it would probably work and you'd probably get a lot of business. So that's sort of an idea concept of how people move based on age, how people buy based on age and babies. All right, so let's talk about inventory. This is national inventory. This is not Temecula. This is not California. This is inventory going back to 1983 for the United States. And you can see the average listings in the United States is 2.5 million since 1983. You average it all, we're at 2.5 million. Look at the high inventory we had in 87, 88, 89, 90. Look at those high bars. That was a difficult time in the real estate market. For those of you selling real estate then, that was a difficult time. And then look at the last, obviously, bubble bursted that we peaked at 3.7 million. Look at 2006, 7, 8. Look how high we got. Well over the average, over 2.5 million. That's a negative sign for housing. That's too much supply and no demand. We would rather have less supply and a lot of demand. So where are we now? We're now at 1.8 million currently, well under the 2.5 million average, which is a good place to be average. We're well under. Not only are we under it, but we're at an all-time low nationally. Since 1983, since this has been tracked, never had less inventory to sell in the country. So this is not what you're experiencing in Temecula, what I'm experiencing in the desert, the Coachella Valley, is exactly what everyone's experiencing in every zip code across the United States of America. So this is a positive sign that real estate values will continue to increase in value. This is another reason why we're going to see inventory stay low and you're going to see prices increase, especially with good home affordability. Look at this. If you go all the way to the left of this slide, you'll see that this is new construction built back to July 2010. 450,000 units built nationwide in July 2010. You can see it increased all the way up until the middle of July of last year. And look what happened since then. I didn't just accidentally push my blue marker down and save the wrong slide. This slide is correct. And that blue line that drops way down from 16,000 homes nationwide down to about 900,000 is accurate. And that's because, especially with COVID as well, it has slowed even more. Builders aren't building new homes. They're not bringing supply to the market. And if they're not bringing supply to the market, it's not going to help inventory levels come up and even get anywhere normal. So once you see builders recover and you see builders putting out a lot of inventory, that's a sign to you that inventory probably a year or two from now is going to be increasing. But right now we're not seeing that. So you're going to see low inventory for several more years. All right, now this is something I think is informative, and I think is something that should really inspire you and give you some confidence that we are not in a real estate bubble. This is not what we saw in 2009. This is not what we saw in the early 90s. This is not what we saw in the mid to late 80s. Okay, we are not in a housing bubble. So for people who are waiting for prices to come down, you're going to be waiting a while, and you better bid and get what you want because it's not going to be there. Okay, so why am I confident about and why do I know we're not in the bubble? Current price to rent ratio is at 17. Okay, well, Walter, what is that? It's the price of a home is 17 times its annual rent equivalent. So let me give you an example. If a home was the rent for $1,000 a month, and you times that by 12 months, so it's $12,000 a year, and you take that $12,000 a year and you times it by 17, so that's the rent equivalent. 17 times the yearly rent, it'll tell you what the value of a home is in today's market, and that's $194,000. I would encourage you to try this metric on some of your listings. This metric doesn't work on the high end. Anything over $1 million, this metric's really tough to work. Okay, but anything under $1 million, which is well below the median home price, okay, which is going to work for most of Temecula and most of the Coachella Valley, which is not the high end, it works. Let me give you another example. A $300,000 home should rent for roughly $1,500 a month. That's a 17-to-1 rent ratio. Okay, where were we in 2006? We had a huge inventory and we were in a housing bubble that hadn't burst yet. We were at 24. 24-to-1 was what people were selling homes based on the rent equivalent. So we are 50% less today. We are nowhere near a housing bubble, nowhere near rent equivalents and sale prices not being together. when you're selling homes for so much more than what they can legitimately rent for, they can never cash flow, and that's not sustainable. Today is sustainable, and they can rent and cash flow, and that makes sense. I hope that helps. I've gone back and looked at, I'm gonna say 50 properties like this, and it works. Equity. This is going to be the driving single biggest component of helping the United States of America pull out of the next recession when we get it. This is very similar to the dot boom, to the internet dot boom we had in Northern California. That was a sort of a blip on the radar, but it was difficult for about a year. But the US pulled out of it pretty quickly, and they pulled out of it because of one thing. They pulled out of it because of equity. The amount of equity people had in their homes. If people have a lot of equity in their home, they will be more confident and be willing to borrow, travel, spend money. And right now, the equity position people have in homes is the highest in the history of the United States. And this chart shows you what percentage of people fall in equity. So this shows you that almost 10% of people have 50 to 54% equity in their home. But if you go all the way to the right of the slide, it shows you only 2% of people in the United States does not have equity in their home. 98% of people have equity, and 98% of people have a lot of equity. Not a little bit, but a lot. And this is going to be the piggy bank that people use if they hit a slow time in their life, if they need money for a remodel, education for the kids that are being born, okay? They have a pay cut in their job or they have to switch careers. This is what's going to help us have a shallow recession when we have our next recession. So let me break down these numbers even more for you. Let me give you a housing overview. 124 million households in the United States. 124 million. Doesn't sound like a lot, does it? 43% of those are rented. So 43% are rented and they do not own. 80.6 million of those households are owned by an individual. Okay, so it's basically a 2 to 1. 34% of the 27 million homes are owned free and clear. So 34% of people who own a home have no debt on it. That's the highest number ever. Look at the next number, 66%. So 2/3 of everyone who owns a home, or 53 million homes, have an average of 50% equity in their home. 50%. That gives a lot of encouragement and a lot of excitement for people to be happy about the future and know that they have they sort of have a backdrop, or they have a second option to turn to in a tough time. So the average equity position in the country, $177,000. That's the average equity position someone has. So the appreciation forecast for 2020 and beyond on residential is hot, baby. It is good. It is bidding wars. It's low inventory. It's low interest rates. Okay. It's people moving to the suburbs, moving to the exurbs, which is great for the Temecula market. It's great for the Coachella Valley market that we're in. So Franklin Loan Center is positioned well to support a lot of people who are looking to buy homes and make a difference in their life. So we're very optimistic about the future. Having said that, I think it's very important that we all take advantage of the market we're in. We all know things can change very, very quickly. Okay, it wouldn't take much for the market to slow a little bit if interest rates pop a full percent. Today's the Fed day, and because I'm on this call, I think they're going to be releasing in about 10 minutes. The Fed's going to be releasing their opinion on this Fed meeting. That drives the market. But for any of you who are on my last presentation in person that we did in Temecula, I talked about the Fed and how we had a dovish Fed. And a dovish Fed means they're going to do everything they can to keep interest rates low, spend as much money as possible to make sure we keep prices flat and unemployment low. Okay, when I say prices flat, not have spikes in prices. Okay, that's the mandate of Congress to do that. And so I'm expecting the Fed to continue to be the backbone with Congress, spending money and doing what they can. And every other country is spending money as well. So we're just not the only ones printing money. So the future is bright with the support of the Fed, low interest rates. I think you guys are going to see a lot of what you've seen the last 6 months. Hopefully with COVID subsiding a little bit, some of the health scares going away. But I think you're going to continue to see the trend of people moving to the exurbs and suburbs until that trend has spun so aggressive in maybe a year or two where the opportunities to buy in New York, in LA, in Seattle, and Portland, the prices are going to be so low, it's going to drive people back there for the opportunity. And so this will be probably a short-lived 2 to 3 to 4 year exit. And as soon as the price is correct in those big cities, San Francisco, you're going to see people maybe want to start moving back to the city life because the opportunity there for value is there. But right now, the value in the distance and space is in the suburbs and exurbs, especially with the COVID market. But that's been the trend for 5 years now. We're just knowing about it. So I hope you all enjoyed this presentation. I appreciate all the support that you give to Franklin Loan Center. As the head of the leadership here, we have great leadership at Franklin Loan Center. We can't do any of this without your support. So we thank you from the bottom of our hearts for loving Franklin Loan Center and being part of our great Franklin Loan Center family. So thank you very much. And I'd love to answer any questions anyone might have about this presentation. Alex, do we have any questions?
No questions so far, but we're waiting. Give them a couple minutes. If anyone can put questions in the questions slot or the chat, either one works.
Even if you guys put a comment, did you find this helpful? Is there something you would like to see me address I didn't? Because I want to continue to do these at least twice a year to support, the Franklin Loan Center Temecula team and the referral partners. And I can do my best to add in any input you guys give me for future presentations as well. How many of you on this presentation saw the last presentation? Any input would be great.
All right. So there's one question from Michael. He said, with forbearance, the borrower can have the payments added to the end of the loan without a modification, correct?
They can have it added to the loan without what?
Without modification.
That's correct. They can have it added to the end of the loan. That's a deferral option. If they do that and they defer, let's say they deferred their payments for June, July, and August. Well, let's say they deferred it for March, April, May, because that's when people started doing it. Then they have to make their June, July, August payment, and then they could borrow money in September. They have to wait 90 days for when the deferral starts. Hope that's helpful.
All right, and then Robert, he said, thank you for this update. It was very helpful. Thank you, Robert. I'm glad you enjoyed it. Wendy, can you explain the term you used, more exurbs?
Exurbs?
Yes.
Yeah, so you've got the urban markets, which are big cities. And then you've got the suburbs, which are typically 30 minutes outside of the urban markets, the big markets, 30, 45 minutes to an hour. That would be classified as a suburb, an hour or two outside the big cities. Then you have the exurbs, which are even outside of the suburbs, where people got to drive 4 hours or 5 hours to get to a big city. And so the exurbs, typically you get more for your money there. You get more land, you get more square footage. And so people are really attracted to that, especially COVID markets, because they don't have to be around a lot of people. So a lot of people don't talk about exurbs, but that's what an exurb is. It's outside the suburbs.
All right, and Cheryl, yes, this was recorded. For any of you that are wondering if this was recorded, it is, and we'll be posting this and it'll be available.
Well, if that's all the questions, you guys can get a copy of the presentation or a video of the presentation from your Temecula loan officers. If you have further questions you think about, please reach out to your Temecula representation and they can get a message to me or they can answer it for you.
We have a few more that just came in.
Yeah, just a couple more. Is there a plan for the homes of the people who are not able to catch up on their loan payments?
Yeah, so the plan for the people that can't catch up, that's to put them to a deferral option. if they can't reinstate, make all the payments in full, or they don't want to do what's called a payment plan, which would be not very popular because why do a payment plan if it's going to keep in a penalty box for 9 months anyway? Just push the payments to the back. The option for people who can't afford to make their current payment when it goes active again after a year. So let's say their payment was $2,000 and that's what they were making all the time. And then after forbearance goes away and they don't have the option, they still can't make the 2,000. Their only option there is going to be a loan modification. And if a loan modification isn't granted by the lender, then it's going to turn into a short sale or a foreclosure. So loan modification is the last resort for a short sale and foreclosure. But forbearance, based on the CARES Act, gives everyone a year to take advantage of forbearance. And then after a year, it's up to the servicer or the lender to give them other options. I hope that answers the question.
Another great question. How will election results affect us or affect the market?
You know that there's a lot of opinions out there on that. I don't think that the election can stop all the statistics we have going for real estate. So I think you're going to continue to see low inventory even after the election. I think you're going to continue to see low interest rates because the Fed is still going to be dovish after the election. And I think you're still going to have the market where people are going to want to be out of the urban markets in the suburbs, exurbs. I think all the trends continue after the election. I think depending on what the new or existing president does policy-wise, that could have an impact down the road. But I think that the new policies would take at least a year to have an impact on what you're seeing now. So I think over 2020 and 2021, I think we're safe to say you're going to see a lot of the same of what you're seeing now in the real estate market.
Right. And what do you make of the news that continue to scream foreclosures are coming? Just see with the equity that you spoke about, why do we continue to see this information, do you think?
So there's a lot of people, especially the media, they live on fear tactics. I watch a couple people on a couple of different, not news stations, but like CNBC, CNN, and you read these experts that they have writing their columns. They live by fear tactics. The facts are a lot of equity in home. So no one's going to go to foreclosure short sale with equity positions. Because there's now forbearance for the next year, you're not going to see anyone go to short sale or foreclosure, so you can't have that stuff coming. Because why would someone do that when they have another option? There's the fear tactics out there. I don't know why the media does it, but it's not true. We are not going to see short sales or foreclosures increase over the next year. Okay, you might see delinquencies increase, absolutely, but those won't turn into short sales and foreclosures. So people are looking at delinquencies, and typically delinquencies do turn into short sales and foreclosures, but we're in a whole new world, in a whole new set of standards. And there is now the forbearance option that has been provided, which has never been out there on a level like it is to everyone who has a government-backed loan, and even people without a government-backed loan, the jumbo investors portfolios, they're offering it as well. So you're not going to see that. That is media being negative, and it's not statistically accurate.
All right. How serious is the foreclosure threat that we're hearing about?
It's not serious.
Okay. And then Prop 13 is under attack. We will be at the risk with the balloon taxes.
Well, everyone said that when the mortgage deduction went from $1 million to $750, it was going to ruin real estate. All your agents that are on the call, you're probably having your best year ever. And that was passed a year and a half ago. I don't think that would ruin real estate. I think it would be a shock to the real estate market for 6 months to a year, maybe. It might slow some people down. I personally don't think that's a game changer. I think it definitely changes the game, but not a game changer. I personally don't think it passes, but that's something that's really hard for me to talk any further than that opinion, because you have to have those types of things pass, and you have to have reaction to it, and you have to be able to judge the facts. I don't know if it's going to pass or not, but right now, I'm not going to worry about that Prop 13 until it actually is something that we have to be concerned about.
And then we have a question on reverse mortgage. Reverse mortgage where the borrower has passed. Does the bank currently have a way to proceed with these, or does the foreclosure moratorium hold also these?
You know what? That's a great question, and I don't have a specific answer for that. I know that government loans have the deferral option as well. So I know that FHA and VA always had a deferral option. Fannie Mae and Freddie Mac up until this COVID environment never did. And that was the real big change, was that Fannie Freddie adopted a deferral option. So because a reverse mortgage is a government-backed FHA loan, I know the deferral option is available there. And so that'll most likely be the option people take when it comes to reverse mortgage. Any more specific questions on that, I'd have to give it an email to me with exactly the question, and I will get you a detailed response. So sorry about not having maybe a complete answer on that.
Right. Do you see evictions going up so landlords can take advantage of the market?
Do I see renting insurance going up? Or renting?
Evictions going up so landlords can take advantage of the market.
Well, the evictions have been postponed to the end of the year. So right now, the evictions can't happen until 2021. I don't know what Congress is going to do in 2021. But if it's not extended, I do think you'll see evictions pop up in early 2021. You don't see how that can really affect the housing market when it comes to buyers and sellers. It could affect buyers. It actually could affect buyers because buyers depend on the income from the rental properties. Without receiving that, they can't continue to buy. So we'll have some adverse connection to the real estate market. I personally think that the eviction moratorium will be uplifted January 1, and people will start being able to evict people that are delinquent on their rent.
All right, and that's it so far.
Okay. Well, thank you all once again for all your support of Franklin Loan Center. I hope this was value added. You enjoyed it, and it will help you in your business and help you with your families and friends as well. God bless you all. Stay healthy and safe, and look forward to the next seminar we do, and looking forward to seeing you all then. Bye-bye.